Welcome to the Penga Folder podcast with your host, Nana and Emily. They invest remotely in the UK and live in Sweden. In this podcast, they will be interviewing interesting guests that all invest in the UK property market.
Today we have the legendary John Howard. How is it?
I'm very well. The sun is out and it's getting near Christmas.
Do you have the Christmas spirit on?
No Christmas spirit whatsoever until Christmas Day. I think a lot is made of it prior. And then my favourite day is the 2nd of January because we can all get back to work. So it's done.
That's the right spirit.
Quite right.
So could you just do, I don't know, I think most of the property people in the UK know who you are, but if you could give a short background, because if you tell the whole story, then that would be a whole other podcast for that.
Okay. So I've been a property developer and investor for 40 years, and during that time I bought and sold getting up to 4,000 properties. My latest large project, which I've just finished earlier this year, was 150 apartments in a tower block, which we bought is a 27 million pound project, and sales are going well. Thank you for asking. So we now I'm now looking to carry on doing my property developments and everything else, but I do some seminars. I do some TV work. I've got a couple of property shows that I've started up, and I'm what's called a co-producer apparently, which sounds very grand. I'm not sure it's quite as grand as it sounds. And I've also just launched the John Howard Joint Venture Fund, where we will invest in other people's deals, as well as the John Howard Bond, which is a listed bond on the Irish stock market for investors around the world who wish to invest in the UK, but don't want to have the hassle of doing it themselves. So we give a guaranteed interest per annum for high net worth individuals, and I do all the work.
So people, if you don't want to invest yourself, then you can just put it in John Howard's fund, and he can give you a interest.
Yeah.
So I have a lot of questions to you today, because you're a very inspiring man, and me and my fiance, who will co-share the podcast, we look up to you. So I'm gonna ask you a wide and a lot of questions.
Okay.
So what question do you ask as a developer when they're seeking funding?
What question do I ask a developer when they come to me?
Yeah.
So on our joint venture, the two things I want to, the most important thing is I want to get on with that. I want to get on with the person who I'm going to invest the money in. So if you don't like the person you're going to invest the money with, then that's not a very good start. So however good the deal is, if you don't get on with the person, then I won't invest. So that's the first thing. The second thing I want to know is that they're realistic, and they haven't got their head in the clouds about prices and values. And I want to know, and most importantly, I want to know, what are they going to do if the first idea they've got with the development doesn't work out? What's their second option, and even what's their third option? Because I believe that in any one deal, you should be able to do three things. You should be able to buy it. If you, having just purchased it, you ought to be able to sell it at a profit without doing anything at all if you paid below market value for it. The second thing you should be able to do is buy it, refurbish it, and sell it at a profit. And the third thing you should be able to do is buy it, refurbish it, let it, refinance it, and get the majority, if not all, your cash back that you invested in the first place. So every deal I look at, and every deal I look at for myself or for my joint venture fund, I want to know that there's more than one option to the deal.
Oh, okay. And when you get the deal, do you do your due diligence, or like do you go really deep into the, like, you call estate agents and etc. or
Yeah. So if someone's comes to me with a deal and they want me to invest my money into that deal, I expect them to have done all that. I will check it and maybe water down some of the figures they've come up with, maybe not. Um, so I'll do my own due diligence. The two things I want to know first always: what is the gross development value? What is the gross development value, and what is the square footage or square meterage? Because from that, I can work out everything else. So
yeah.
always work from the end backwards. So always know what you can sell it for, and then if you work backwards, you can soon work out. As long as you've got the square footage, you can work out exactly what you should be paying for it in the first place.
Wow. Okay. And what type of security do you want to have?
Okay, on the joint venture deals, we take a second charge. So the bank take the first charge. We expect the bank to do 60% of loan to value, something like that. We put in the deposit. So we've just done our first joint venture fund. We've just done the first one in Kingston upon Thames. Quick example: a lady, she paid 800,000 for the property. We put in 365,000, and the bank did the balance, so they did 60% of the purchase price roughly, and they're putting the building work in. We're doing converting into two flats. So a very simple, straightforward deal. They don't need to be complicated. In fact, some of the best deals are the ones that aren't complicated. Nice, simple, straightforward. And if we can't sell them for any reason whatsoever, we can let them, and the return is good as well.
Yeah. Yeah, you'll figure that out.
Yeah.
I think so, John. So how long did it take how long did it take for you to achieve financial freedom?
Goodness me. I was someone said to me a while ago, he said, "Well, you're a bit like an old pop star, really, aren't you, John?" So I said, "Well, what do you mean by that?" He said, "Well, you had a few hits early on in your career, and then you went a bit quiet, and now you've come back with a few more hits." And I thought about that. And I thought, well, I got off to a relatively good start, and then I met a guy called Robert Boyce when I was 24, and I'd done a few deals, but by then, and with Robert as my backer, we did some quite big deals. We bought tower blocks, refurbished them, and sold them off to individuals, in first-time buyers, and also all around the UK. So I suppose in that respect, I got quite a lot of publicity for that and bits and bobs. So in that respect, I suppose people are right. And then the recession came. We survived the recession, and I was doing probably slightly smaller deals, a lot of office to residential. Of course, everyone thinks office to residential now is all new. It's been going for the last, I should think, 100 years. But anyway, I've certainly been doing office to residential for a long, long time. Anyway, so I did that and kept busy and kept earning money and so on. And then I suppose more recently I've had some more high profile deals, like the 27 million project I've just finished and we're selling. And of course then I wrote between that I wrote my books, and that's led to me helping a number of people through seminars and bits and bobs, a little bit of mentorship. I haven't got a lot of time for mentorship because I'm busy doing my own deals as well as my joint venture deals and so on. But I do a little bit of that. But I really enjoy the seminars because I like meeting people. And obviously this year, public speaking's gone, it's been difficult on Zoom and so on. I did my first Zoom call, really. This is how backward I am, or backward is the wrong word probably, but archaic, if you like. I did my first Zoom call with Ranjan in March. We were meant to do a live event. He said, "Look, we're going to do it on Zoom." And I said, "Well, I don't really know much about Zoom." But anyway, so he said, "Well, don't worry, we do this, that, and the other." Anyway, it was all a bit stressful, but I was speaking live to 1,050 people, and you just think you can't see anyone. It's a bit bizarre. You get ready in the bedroom, you come down, and it's all very bizarre. But anyway, it went okay. So that was the main thing. And I've done quite a few since, obviously, and it's not the same. I enjoy. It's great. It's handy not to have to travel anywhere. But I think most people are yearning to be able to get on stage and, speak to people and have some banter and some rapport and a bit of fun. And I wasn't sure whether some of these events would come back early in lockdown, because I thought, well, this Zoom thing's so clever. But I actually think now, what do you think? I think they will, don't you?
Yeah, I think so as well, because I miss it. Because
Yeah.
it's
Yeah.
it's something else to talk with someone on Zoom and meet them. Like the conversation we have now, I think it would be much even fun if I met you in person and we were having it.
Absolutely. Well, we'll do that soon, won't we? I'll fly over or something like that, or you can fly. I went to Sweden back in when I was a director of Cambridge United Football Club, and I went over to Sweden. We played. We had the only tour Cambridge United have ever done, pre-season tour that we got paid, I think. And we went over to Sweden, and we had 2 great weeks over there, training and playing. It was good fun. Very lovely country. It's good fun.
I didn't even know that you played football.
No, well, I didn't really. I was a director, so every football director is a frustrated footballer. Really, it wasn't good enough, and so I became a director. I was sort of the youngest director in the Football League at the time, when I was about 25. So I used to come off the team coach, and people thought I was a player, which was great. They wouldn't want me in the team, though. That's for sure.
Okay, so then my follow-up question: how long do you think it will have taken in current time for get financial free? Let's say if you will start over today.
That's interesting, because I mean everyone thinks that, when whoever, it's like when you buy your first house to live in. When your parents did it, if they were fortunate enough to be able to do it, it was much easier for them. It was much easier for their generation, and so on and so on and so on. And I have to say, to be absolutely honest, I think the opportunities that people have now with well, you just take my joint venture fund, literally you only need to have the money for the stamp duty and legal fees, and we're covering the rest if the deal's good enough. So, and you get half profit. So to be honest with you, we never had anything like that in our day, and you really need to define 50% to put into the deal, and there are very few backers. There is so much money available to people now. It's so easy to raise money compared to what it used to be at higher levels. So I think it would be easier now than it was then. The one thing I would say against that was that there was much less competition. I mean, the competition these days for deals is fierce, really fierce. But you still need to have high standards, especially next year when we're not sure what the market's really going to do. You've got some people saying it's going to go down 10%. You've got others saying it's going to go up 5%. Property Summits yesterday, which is a group of 5 of us who got together, all good guys, well, the other 4 good guys anyway, who are genuine and give sensible advice and not trying to plug every 5 minutes their business. And interestingly, the 4 of them, Nicholas Warwick, Tony Gimple, Paul Mahoney, and Richard Bush, who's got crowdfunding, they all think that the market's going to be okay next year, which is very interesting. I'm more cautious than that. And I think people need to be looking for deals with a higher margin of profit in than they would have done in the past, just to make.
Yeah, I remember when I wrote to you I think it was in March, and I asked you this: what
did I say?
Think the market,
what did I say?
And what are you doing? You were like, I'm just sitting on my hands.
Well, I sat on my hands. I did quite well sitting on my hands till about September, and then Allsops had a site in their auction that was 20 part finished houses that the bank had gone bankrupt, the builder had gone bankrupt. It went to the auction, didn't sell. So I paid 1.8 million after the auction for that, and we're just getting sorted now, getting back on site now to finish them. So I've sort of I was, for me, pretty I'm cautious anyway, but that was an opportunity that I could.
That deal seemed like it was too good to be passed on.
Yeah, well, when you're buying distressed stock, the one thing you've got to be careful when you're buying properties where people have gone bankrupt is that you're not going to get any help from anyone as to what's wrong with them. If anything, you've got to really investigate them thoroughly, and you need some experience to do that. But part of the bond, the reason for raising the money in the bond is really to do projects like that, because I believe in the next couple of years there will be a number of distressed assets, and we want to take advantage of it.
Okay, so what should an investor be aware of?
So
that's a wide question.
It's a very wide question. It's a very good question. When you say investor, do you mean an investor who's going to just buy property to keep and to look after for many years, or do you mean as someone who's going to develop properties?
Both.
Okay. Right, even bigger. Okay, well, if you're going to buy a property in the UK at the moment, if you're going to keep it over 20, 25 years on a buy-to-let type of mortgage, then really, does it really matter when you buy? It matters less when you're going to buy a property like that, because over the years, the UK property market's gone up 5.5% for the last 20 years. Now, in that time, we've had slumps as well, but if you buy in the right areas, that's what the yield has been. So actually, if the market goes down 5% next year and you're keeping it 20 odd years, does it really matter too much? As long as you've got a good tenant, you've got income coming in, it probably doesn't matter. So the investment side of it is quite a cautious approach, if you like, to property. The property development side is very different. And you can very easily, without experience, get into all sorts of difficulties and troubles, and that's where the one thing I fear with people is that they see no danger. So when people come to me and say, "Look, John, would you help me? I want to do this, want to do that," and with the joint ventures, they bring these joint ventures to me, and they don't see any fear in them. They don't see any loss. They can only see profit. And of course, if you get it wrong, there will be a loss, And so I would say the biggest thing is to be cautious, to really do your research, look at the figures. And also when the house next door or property next door has gone for, say, 240,000, if that's what the estate agent's told you, go and check it on Land Registry, because it might have sold for 225. It might have been on the market at 240, but it might have sold for 225. And at that level, that's 10% different. So it makes a lot of difference. So always do your own research, listen to what the estate agents tell you and everything else. But you are making the final decision. You are the captain of the ship, not them. Every time an estate agent wakes up, guess what? He pulls the curtains down, or she pulls the curtains back, and it's a sunny day. They never have a bad day according to them, and there's never a bad market according to them, and we know that's very different.
Yeah. So basically, trust but verify.
Trust but verify. Yeah, that's I like that. Yeah, very good.
So, what signs can you see heading into recession? I know UK went into recession, and then the third quarter they went out, but we know that it's still a recession.
I mean, the good news for property investors and developers is that when there's blood on the street, as we say, there's opportunities. And I've made more money coming out during or coming out of a property recession than any other time. And the reason for that is when the market's really hot and everything is going up, I'm relatively cautious. So in that situation, other people will build in more profit on the basis that by the time they come to sell, it will be worth more, which is very, very dangerous. But what it means is that people like me don't do very well in a hot market. Where we do very well, hopefully, is in a difficult market, the sort of market we're going to come into. And I think that it is a two-tier market. So you've got the domestic market where people are buying a house to live in. And if they're buying a house to live in, again, if they're buying it for the long term, does it matter whether it's, whether it goes down 5% next year or not? Probably not. It's their home, it's where they want to live. So the domestic market's one thing. Then you've got the investment and the developer market, which is the sharp end of the job. And certainly in that market, I've already demonstrated that the site we bought in Birmingham, where a builder went bankrupt, the bank went bankrupt as well, and the builder went bankrupt. So there will be opportunities. I'm looking at 2 or 3 other sites at the moment where the builder's gone bust. And that can be for a number of reasons. I appreciate that. Not just the market. Sometimes they've just overstretched themselves or whatever. But so there will be opportunities, but you have to be careful and you have to do the research in the areas. For instance, the Northeast, which is an interesting area of the country, is actually the population in the Northeast is going down. So, do you want to be investing in an area that's going down? Of course, it's a micro market. So some of those areas of the Northeast are very good and probably going up. But overall, the population's going down. So you've got to be really careful. And it's a dangerous market to be in when you don't know what's going to happen. And you might be best to buddy up with someone who does know rather than, first-time developer. There's nothing wrong with investing with someone else who is experienced and learn from them, especially in a difficult market.
Yeah. So let's say if you're going to do it yourself, you should be very cautious, right?
Yeah, I think, yeah.
Yeah. So now should people maybe sit on their hands like you did and wait for a good opportunity, or should you still be looking?
I think you've always got to be looking, because even in a bad market, I've demonstrated that even in a market that you're not sure about, if there's a real bargain, like I believe Birmingham, the one we just bought in Birmingham is, then there's a lot of money to be made. So, and also, in that Birmingham deal, I've got a number of options, and I like options. So there is 20 odd houses. The first 6 are part finished, so we could finish the first 6, get the majority of our money back. And perhaps sell the site off at the back to someone else, or do some of it, sell some of it, rent some of it. So there's a number of options, and I think, like we said before, you need options. If you only got one option, you're probably under serious pressure. And if you pay the right amount of money for a property deal, there should be a few options, like we said.
Yeah. So what should we calculate on? Like, should it be like 10, like you mentioned, the guys that you met yesterday, what were they saying? Should you calculate like 15% below?
Yeah, well, they, I mean, the guys yesterday were saying that they thought the market would rise up to 5%. Zoopla, who's one of the websites here in the UK, that they were property websites, they're saying that the market could rise 5% next year. And the reason for their argument for that is that people are moving out of the cities because of the COVID and everything else, reevaluating lifestyles, which I think is very true. But these people are wealthy, they're not the average person. I've got a estate agency business we own in Norfolk here, county in Norfolk, which is a lovely county. And we've got 5 estate agencies in the county, covers the whole county. And we've had the best year we've ever had. But that's only because people are coming out of the cities into the country where we are to buy. They're not the average buyers. These are wealthy people looking to buy nice houses. Going forward, unemployment's going to perhaps go up to 3 million. You've got huge deficit. I mean, they're talking COVID's cost this country 300 billion so far. I mean,
wow.
We're talking massive figures, and somewhere along the line, we're going to have to pay. We're going to have to pay it back. But the economy, they're talking about 7.5% of the people out of work. These are big figures, and even if people do have a job, they become very cautious about moving. Is it the right time to move? And if there's a couple, one's keen to move, one isn't keen to move, then the one who isn't keen to move can use all the excuses under the world to stay put. Oh, it's not the right time. It's, we've got to be careful. We're in a recession and all the rest of it. I mean, the next 2 or 3 years are going to be very, very tough for the UK. Very tough.
Yeah. So do you think the bubble that people are in now, because that exactly what you were saying, that what I was thinking when this hit COVID. I was like, okay, people were gonna keep on to their money, they won't spend, but they just did the opposite.
They did exactly the opposite to what I thought, nearly. Well, there was a bit of a pent up demand domestically. There was a pent up demand, so people were sitting at home thinking, "Oh, I was going to move in 5 years. We're going to move 5 years time. Why don't we do it now?" And I think a lot of that, when people at home, they got time on their hands. I mean, I'm never at home hardly, and obviously this year I've been at home and I've decided, my God, I've lived here 28 years. I've got to do this. I've got to do that. So I've got the bill. We got a lot done. So other people were reevaluating their lives, and all this business about traveling to London every day by train for 30 years, it's not going to happen anymore going forward. It's changing. So I think that's why there was a pent up demand. And I think with low interest rates and also with the stamp duty holiday the government gave, that finishes in March, and that could be major. If they don't renew that holiday, that could cause a major problem, because it causes a false market. So up till March, we'll probably be very busy selling property. After March, it just cuts it straight off. And I'm not sure if they've got any sense. I don't think they'll do that. I think they'll carry on with some sort of stamp duty holiday. Maybe they'll reduce the amount of money that's the holiday's not up to 500,000. Maybe it goes down a bit, but I don't think they'll get rid of that completely. I don't think they can afford to, and I think they understand that. And they say this, that for every property that's bought, 5% of the value of the property is then spent refurbishing that property. So it creates the housing market in the UK is incredibly strong anyway, but it also creates so much other work for other people, like curtain makers, carpenters, kitchens, bathrooms. So it's a major driver, and I don't think they've got the balls to pull it completely. They might pull it partly, but not completely. If they pull it completely, then I think we've got a problem. I think the market will deteriorate. So really, I think that's what's happened this year. And of course, even if the developer's been in trouble this year, they've got out of trouble by having a COVID loan off the government, and also the market's picked up for them, so they managed to sell a few. But all that's really doing is papering over the cracks. I mean, people haven't had to pay tax this year; they could defer it. Well, but it can only be deferred till next year when it needs to be paying. So people are going to be under serious financial pressure next year, and a lot of people sadly have lost their jobs.
Yeah, that's true. So you've been into several recessions.
Yes.
So in all property recession, which one was the worst, do you think?
Well, first of all, what happens in a recession is that most people are in denial. So no one wants to hear bad news. So what you find is everybody with a lot of property on their hands or investments and bits and bobs tend to bury their head in the sand. So they don't believe it's going to happen. Like now, they're all saying, "Oh, it's going to go up a little bit. We'll be all right," and all this. They may be they may be right, but I'm not sure. I don't believe they will be. But hey, we'll have to see. So first of all, there's all denial. There's denial. Which isn't helpful. So property is like a big boat. It takes a long time to stop and turn around and come the other way. So what's happened this year is that, especially in the auction market, which is a great barometer, because what happens in the UK auction market happens normally everywhere else later, because it reacts the quickest. So up till now, the UK auction market has been crazy busy. Very hard to get a deal. Very difficult. And that's why I've said to people, look, just hang on, because next year it won't be as busy. Everyone's running around. I think a lot of them are trying to, what I call, buy income. So what they're trying to do, they've got some money, it's burning a hole in their pocket. They're desperate to buy something. They've been locked up for God knows how many months. And what they've done, they've gone out and bought a property for income and that type of thing. So that's really what they've done. And the one thing I would say to people who are frustrated is the people that have already bought aren't likely to buy another one. So all the ones that have gone ahead and jumped in and bought at auction and paid probably too much for it, they're not going to buy another one. They've bought theirs. So by being cautious and being calm, and being patient, you will get a better deal. Simple as that. Simple as that. You'll get a better deal. So that's I'm just going to. So that's the.
But you've been in several recessions. So which one has been the worst?
Sorry, yeah, the worst one was the early 90s, because interest rates were 50. Normal interest rates. I don't mean the interest rates the banks charge. I mean the interest rates for house buyers went up to 15%. 15%.
Wow.
For a short time. But on average, 10%, a 10% mortgage interest on your mortgage for many, many years was average. All this business about a 2%, a 1.5%, and 4%, 3% is all only in the last 10 years. I mean, it really is. And now, of course, everyone's so used to it that if it ever changed, it would be an absolute disaster, because that's what everyone's used to. But genuinely, 10% interest rate was average. So what happened in the 90s? The market dropped 35%. 35%. So anybody was struggling. If you got a 30-40% equity in your property, which you need to have ideally, that was wiped out.
So were they calling in the loans?
Oh yeah, calling in the loans. Some of the banks were in difficulty, like they were in 2008, 2009. I found the 2008, 2009. I found that recession relatively, maybe because of my assets, but relatively easy to help. In fact, during that time, we bought Auction House UK, which had 7 franchises at the time, and we built it up to 42, and we sold our shares a couple of years ago. So we took advantage of the market being difficult. But when you're in a recession, there is no rush to buy, because there's a saying, never catch a falling knife. And okay, if you're experienced, you can do, but you've got to be very careful. But actually, most recessions take 2 or 3 years to see out. So you're not in any particular rush. And I'd let it bounce off the floor a little bit first before I jumped in, if I wasn't very experienced. And certainly with auctions, you can do that, because if you follow the auctions, basically most auctions, average clearance rate in auctions about 70%. That rate goes down to 50% in a tough market. So it's a great barometer. So when you see it coming back up again, then that's the time to start investing.
Yeah. Okay. What do you do during recession as a property developer investor?
Well, that's really good. Great question. Last time round, 2008, 2009, I started training racehorses. So at home here. So I had about 24 horses in training. So I was doing that part of the time. I was still looking for deals and doing deals, and we bought the company. So we bought that company, Auction House UK, and so on. But that's what I did. And actually, I know people who would have done far, far better to go on a 2-year round the world cruise and spend their money doing that than they would have bought properties, which they did, lost money on them because the market kept dropping. They'd have had far better time going around doing a world cruise or a world trip, come back and then start again when the market improves. You've really got to be careful. Of course, a lot of us are firefighting during that 2 years or 3 years, keeping everyone happy. But I mean, if some really clever guys and girls, they cash out. Yeah, they cashed out this year. They're sitting on loads of cash, and they're sitting there waiting for the market to drop. So, but of course, it's always hard to do the timing of it. I mean, we've done that to a point, I suppose, and we're raising money through our bond in order to be liquid and have plenty of money to spend on opportunities coming up. So I suppose we've done the same thing, really. Yeah.
So what are the trends during a recession? Like, is it buy-to-let, HMO, conversion?
Well, but yeah,
commercial,
during a recession, the very hardest properties to sell are the ones that need a lot of refurbishment or development, because that's, cash is king, and people have got to spend a lot of money before they get income on it or they sell it. And of course, so all the properties that are in very poor condition, all the ones that need planning permission to change into something else, they're the properties that really suffer in a recession, really suffer. The ones with income, just like if you were buy to let, you bought buy to lets and kept them for 20 years, they don't suffer quite so much because they've got income, and most people can survive, even if the value of the capital value of the property goes down. As long as it's let, you're pretty safe that no one's going to take it off you. So as long as you're paying your mortgage and it's let, then really that's pretty safe. So that's the stuff that holds up relatively well. The stuff that doesn't hold up well are the bigger development sites, and the more building work that needs doing to a project, the cheaper it is in a recession. So it's mainly, yeah.
Yeah. So could they take the property from you even if you pay the mortgage?
Well, that's interesting. If you've got a buy-to-let mortgage for 20, 25 years, no, they can't, as long as you pay the repayments. But, and this is what happens in a recession, if you've got a bank loan or an overdraft facility, what happens is this: you have an overdraft facility, say for £1 million, which is 70% loan to value. Your facility runs out, so you've got to go back to the bank to renegotiate. They say, okay, yeah, well, we might do it. Obviously, things have changed a bit. We now only lend 60%, not 70%, and we need to revalue it. So they revalue your properties that you thought were worth £1 million, and they then come back and say they're worth 800,000. Then they'll give you 60% of 800,000. So suddenly you've got to find £200,000 from somewhere. You can't find it. So what happens? The bank force you to sell it. That's what happens. So what starts off as no problem soon becomes a problem.
Yeah. So maybe then a smart move maybe is to maybe do repayment, have a repayment mortgage instead of interest only.
Yes, rather than an overdraft facility. But a lot of the bigger you get, the more often, the easier it is to work off an overdraft facility, because you might be doing this, that, doing lots of different projects, and lots of, when you grow, it can be difficult to do an individual mortgage every time. But yes, during this, it's much safer to have a long-term mortgage on a property than it is an overdraft facility, without question, because overdraft facilities are normally annual, or perhaps, a 3-year facility, which has to be renewed. So they're the people that get into trouble.
And can you explain what it is for the listeners? I know what it is, but maybe they don't know what this overdraft.
Say you own a property outright, and it's worth £200,000, and you want to trade. So you want to buy other properties, perhaps without having to go back to the bank all the time and so on, each time individually. So you would go to the bank and say, look, I've got this property, it's worth 200,000. Will you lend me 150,000 against that property? And they say, yes, we will. It's a 2-year overdraft. So after 2 years, you have to renew it. So you go off, you've got 150,000, you start buying terraces up and selling them and doing all sorts of different things with them. And then after the 2 years, the bank say, right, 2 years are up, we need our money back, or we need to renew it for you. So they look to renew it, and that's when the problems start arising if the market's dropped. Whereas if you go and buy a property and mortgage it for 20, 25 years, in principle, there's nothing the bank can do as long as you're paying the mortgage each month and you're not doing anything that says you can't do within the agreement of the loan.
Yeah. Good explanation, John.
Thank you.
So what's your take on social housing during a recession?
Very good news. Very good news. So at the moment, there's a trend for these local authority councils to look to the private landlords to fill their housing requirements, because they've just got so many problems, so many people that need housing. So I know a number of schemes that local authorities are doing where they say, well, I'll tell you what we'll do. We'll take this flat off you for 3 years. We'll pay you just about the going rate, and we'll give you a £1,500 grant for repairs or whatever it might be on top. Now, the problem is they obviously put in whoever they want. You can't control that, but you get it back in the same condition in 3 years' time as you gave it in. And of course, the good news is that you're going to get you're guaranteed the rent. So sometimes they offer a bit less rent, but when you think about it, you've got no voids. Any void will cost you at least a month's rent because it takes time to get the new tenant in. No voids, and you've got nobody having to collect the money on your behalf. So you've got no commission or anything else. So actually, if you can let to a social landlord, a social tenant in some way via the council or housing association, that's great news. And we've just done a deal on a block of 14 flats. We did a PD scheme, and we've just sold them to a company that let the flats to a housing charity that are funded by the local authority. So I think they have assisted living, really. So I think they have one manager in there who takes the flat, and then the other 13 flats are let to people who perhaps can live independently but need some help.
Yeah. So then maybe that's a good strategy to
Very
do
good
during
strategy. Very safe.
recession.
Yeah, very safe, very sensible. Bit boring for me, but if that's what you like to do, that's fine. I've got a portfolio like lots of people all over the country, and I have to say, I duck out of all the. I have someone look after it all for me. I'm very spoiled. I duck out of all the problems. I don't get involved. In fact, I've got some flats in the Isle of Wight that I haven't seen for 25 years.
Oh, wow.
But they keep paying the rent, so hey.
The legend, John. So, when calculating a deal, what margin should you have?
Okay, well, the famous margin the famous amount everyone talks about is 20%. 20% margin, net profit after all costs. And when I say all costs, I mean all costs: interest, council house tax, taxes while it's empty, electric bill, the whole damn lot, everything. So many people said to me, "Oh yeah, well I made this and that out of it." And you say, "Well, did you count the interest? And did you count this and that and the other?" "Oh no, I didn't mention that." So I'm suggesting today, live on this podcast, that you should be looking for 25%, not 20%. And the reason I'm saying that is because you don't know what the market's going to do. I don't know what the market's going to do. I've got to do a YouTube later where I've got to predict next year, and I'm like, well, what do I say? All you can do is be honest. I mean, I can only use my experience of 40 years to say that, when people start banging on about there being an increase in value, when you've got the biggest worldwide disaster ever, the highest amount of unemployment you've had for ages, and where the governments are borrowing billions and billions of pounds, it doesn't sound like to me the market's going to be too good. Does it you? So
No.
but perhaps I'm wrong, but we'll see. So caution. And the one thing I'd say to people this year, I've said to people this year, is even if I've got it wrong, even if I've got what I've said to you today all wrong, you've still got your money to invest. And if I've got it right,
that's true.
If I've got it, you've still got your money. So if I've got it right, you'll be much better off. If I've got it wrong, you've still got your money to go again. You haven't lost any money by taking my advice. If you didn't take my advice and you bought at auction and you paid too much money for properties at auction, and next year they're 10-15% cheaper at auction, because don't forget, auction's the sharp end of the market. That's where you'll find the first bargains in auction, because those properties have got to be sold. So and it happens quicker at auction than any other market. So even if I have got it wrong, you've still got your money to invest next year.
Yeah, that's true. That's true. I think people are so impatient. That's why they just want to, they read a book and see you guys on Property Elevators, and they just want to, start the career.
I think that's like right.
You're saying.
They do. And one of the reasons I wrote the books I've written is because the advice that people are getting from some of these educators and so on is not good. They make out that anybody can do property, anybody can make money. And I've had people on my seminars, and at the end, I've pulled them to one side and said, look, I know you've got some money to invest, but you're better off to invest it with someone else than you are yourself, because you haven't got what it, I'm being unkind, they might be very bright, but it doesn't mean they make good property developers or investors. They're far better to give that money to someone else to invest for them than they are do it themselves. And I think, not everybody, the problem with these, a lot of the property educator people, they make it sound so easy and that anyone can do it.
Yes.
And it's just not true. Not everyone can do it. It's very wrong to mislead people in that way.
Yeah, that's true. Like I can tell you from my experience. So from the people that signed up, did the course and the mentorship from Sweden to UK.
Yep.
We were like, I think it was maybe 40, 50 people.
Yeah.
Out of those 40, 50 people, it's just maybe 4 companies.
Yeah.
That's doing it.
Yeah.
All the other have just quit.
Yeah.
But the education still got the money for.
Yes, absolutely.
You know what I mean?
And sometimes the one thing to ask these people, how many deals have they done themselves? And most of them are hardly done any. They just teach it, and I think that's wrong personally, but they make a good living at it, and they've always got somebody who they put on stage and says, look, they've done it. That means you can do it.
Yeah,
well, it doesn't always mean you can do it, and it's very, very misleading. And we all know the main culprits, but there's plenty of others as well.
Yeah. So then I have this question. If you were starting today during this climate, what would you do?
Well, if you're starting today and you're ambitious and want to get on, then you need to do some trading, because it's okay buying a property and sitting on it, looking at it for 20 years, yeah, or buying it, keeping it, and then refinancing a few years' time, buying another one. But it's a very safe job, and if you've got another income and another business, that's fine. And that's what a lot of people do, and they can build up a very large portfolio by not having to delve into, the profits of that property. If it's your own, if you're anyone's like me, you live on your wits, as we say, then I need to do some trading. You need to trade, and that isn't easy, but property trading is by far the fun bit of it all. And if I can buy a property and sell it without doing anything to it, and I manage to do that sometimes 2, 3, 4 times a year, then that's great. That's great fun. I can't rely on it. That's your problem. You can't. We can rely on rent coming in on the whole, but you can't rely on finding enough deals to just trade and do nothing else unless you're exceptionally talented and you've got exceptional contacts. And the market, because sometimes, the market dictates what you can do and what you can't do. But the biggest thing I can say to anyone is surround yourself with good people who you trust, and make as many contacts as possible. I'd still try and meet at least one person a day, and make a new contact every day. Okay, some of them don't work out, some do, but experience and time, the most people you can meet, the better. And all those people can work with you. You don't have to work against each other. You can work with each other to find deals and trade between yourselves. And you might like buying and selling terrace houses. Someone else might like to buy and sell, shops or whatever it might be. So you will get to know, oh, I know Martin might buy that, or Lizzie might buy that. She loves that sort of thing. I don't do it, but so you can earn yourself a finder's fee from different people. And that's finding deals for other people as well as doing it yourself has got to be the way forward if you're full-time. If you can do it part-time and you've got a full-time job, please do not give your job up. Keep your job as long as you can afford to do, long as you can keep it, because that takes the pressure off finding deals. There's nothing worse than you feel mentally forced into doing a deal because you feel you've got to, even if the margin isn't good enough. If you've got income coming in from elsewhere, you don't need to do that.
Yeah.
It's not the
So
amount.
basically, you could be.
Sorry.
So basically, you could be the sourcing. You could do flips and even rent to rent. Then maybe
Absolutely,
because
there's nothing wrong with rent.
trading as well.
There's nothing. Just because with rent to rent, just be careful. You've got to hand it back in the end, and when you hand it back, it needs to be in the same condition as you took it in. So if it suddenly needs a load of work done to it, you're in trouble. And you spent all the rents, you're in trouble. At the end of the day, it's not the amount of deals you do, it's how good those deals are. So if I do 2 deals a year and they're fantastic deals, it might be frustrating that I haven't done any others, but I could run around doing 10 deals a year and lose money on 8 of them. Which would you rather do? So
2 deals.
Exactly. So it's not just because you're running around thinking you're busy doesn't mean you're making any money.
Yeah. Okay. So I've come to the end. I love this conversation with you, John. So I have some few questions left.
Okay.
So what tips can you give us as an international investor that want to invest in the UK?
Well, what I would say as an international investors investing in the UK, it's difficult. I've got a gentleman in Israel who I'm helping at the moment just to do just that, and it isn't easy if you're not based in the UK. So there's only 2 things you can really do. Really, is invest in a bond, the sort of bond that I'm doing or other people are doing. If you're going to invest in any sort of bond or arm's length dealing in any shape or form, please investigate the people thoroughly. If they don't want to be investigated or they won't give you the information you want, the alarm bell should ring. Search them on the internet, find out if they've got problems, search their companies, see if they've got any money. Because if they haven't got any money in the first place, then really they haven't been very successful, have they? So if you're going to do arm's length investment with people, make sure they've got money, and make sure that your money is secure. So many people, I'm told, just send a check to someone. I mean, it's unbelievable. It's madness. Make sure it's done legally and professionally, and you're not lending to some individual who you've never met. Always you can come. I'm meant to be off to Asia January, where I'm going not to meet a number of investors who want to meet me, and that's absolutely right. It's how it should be. I'd be happy to fly up to Sweden if there's a few investors there. So, these people.
You're welcome.
They want to thank you. They want to meet you, and that's absolutely right. And why shouldn't they? And they want to learn. They don't want to just sometimes put the money in and walk away. They want to put the money in and learn and have contact with you, which again, that can be sorted out. That's not a problem. We can do that. So that what I would say. So arm's length is a lot easier, because you're not having to pop over every time to sort problems out. If you're going to invest in property, which is let, then that's a lot easier to do, obviously, from abroad. And there's some very good property management companies and people who will help you do that. So you don't have to be, in situ, as it were, to if you're going to invest in property or for the long term. But certainly, if you want to do developments, then that's very hard to do from a distance unless you have help and people overseeing it on your behalf.
Yeah, that's a good answer, John.
Thank you.
So I have these 3 questions I always ask my guest, or 4. The first one is quite funny to ask you. But I'm going to ask it.
Okay.
If you had unlimited funds, who would you be your mentor?
If I had unlimited funds, well, if I had unlimited funds, I suppose I wouldn't need one. That's a really good question. I would say my Property Summits partners. So we've formed this group called the Property Summits. And the reason we did that, the 5 of us, is because we're all professional, and we give professional advice to professional people, really. And each of us have got a different skill set. So, someone might come to me and I can't help them because I don't do that, but Nicholas Warwick does that, or Paul Mahoney does that if it's long-term investment or whatever. So everyone's got a different skill set. So I think I would give the money to them. Yeah, let them get on with it. Take a bit of pressure off myself. Yeah, give them some stick, as I do anyway, when we meet. So yeah, and we do some live. So next year we're going to be doing some live events. We did one this year, and then of course we had lockdown. We couldn't do any more. But the idea is we do about 3 live events a year, and it's all quality advice and from professionals. Yeah,
I will definitely come and see that.
that would be lovely. We'd love to see you there, and we normally feed you as well.
Which is good.
Yeah,
I like effort. Food.
Yeah, it's good effort.
So then to books. What book would you recommend to your children? It doesn't have to be property.
This is going to be seriously controversial, but I would ask them to read Art of the Deal by Donald Trump.
I like that one as well.
1980. We wrote it in 1988 or something, but it's just interesting. And one thing I've learned from that book, I will always remember, is that some of the best deals are the deals you don't do.
Yeah.
Some of the best deals, he says it in there. Some of the best deals are the deals you don't do, and that is absolutely spot on.
Yeah, I love that book. I've read 2 of his books.
Have you?
But Art of the Deal.
Yeah.
And then the second one was this 100 tips from different real estate people.
Yeah. No, that's that. And I know he's he's super unpopular in many quarters, and for the right reasons, I have to say on occasions. But I mean, he's been a remarkable developer, and I know he's made it, he's lost it, and a lot of these big time developers, they make it, they lose it. They have the ability to bounce back that others don't have, and they have that certain exuberance and confidence with what they do. Sometimes they get carried away, like he did in the 90s, and he came a cropper, but he bounced back. Yeah.
And one book for every investor. It doesn't need to be property.
Well, that was it. That's it, Donald. Donald.
Is that all?
That's it. No other book. That's it. That's all you need to read. Get dealing. Get some deals done. Yeah.
Okay.
Business is everything. Yeah.
Okay then, John. Thank you very much for being on the podcast. This has been amazing, and I've been thinking about this episode, doing it with you, and you've given the listeners a lot of golden nuggets and all of the information and all of the experience that you have. How can people reach out to you?
They can
follow you.
Yeah, well, I've got a YouTube channel, but I never remember what it's called. I'm not that commercial, as you can see. But if you put John Howard Property, I'm sure you'll find it. And I try and do something on there once or twice a week. It's all free, of course. My seminars, I do a few seminars around the UK a year. Not that many because I'm busy doing all my own deals and so on. But I do some. And if they go to John Howard Property Expert, they can certainly get hold of me. And I pride myself on responding to most people within 1 hour.
Yeah.
Sometimes it's 2.
There you have it, people. And if you haven't seen the Property Elevator, where you see John shine and dictate every other property experts, go and watch it. It's free on YouTube, and it's really good.
Thank you. Thank you very much indeed. It's great. It was a pleasure to talk to you.
Likewise. I don't know if I would dare to be there.
Well, we're very kind to everyone. To be fair, we were disappointed that with the new series starts in March. Actually, we're filming again in March, the 3rd series. And interestingly, we were really disappointed. We didn't have any really cocky young guy come on, who thought he knew it all, because we're waiting for one of them, and everyone was so nice. We couldn't be rude to anyone. So we couldn't take anyone down a peg or two because they're so humble and so kind and decent, which was a bit of a shame in a way. Everyone's just too nice. But it's great. It's great fun, and Ranjan's good fun, and Helen Chorley, and Nicholas again, and Paul. They're good. They're really good people, and very, very bright. And there's something, again. There's something for everyone in that show, and you can learn a lot. Even if the deals that don't get done, we explain why they haven't been done, why we didn't want to do them. And I think, you can learn more about the deals you don't do as much as about the deals you do. So all your research, everything you do, people say to me, oh, just wasted 3 months. They haven't wasted 3 months because they've learned so much in that 3 months. There's no time that is wasted. If you're analyzing deals, looking at deals, you'll get to feel what you want to do, because there's lots of different ways of making money out of property. It's up to you to find a route that suits you, not that suits the person who's trying to manipulate you by education. The educator should give you the opportunity to say, look, you can do all these types of different things. It's up to you to decide what you want to do.
That was a good ending there, John.
Thank you.
So people, don't be stressed, invest. Take care. Bye.
Bye-bye. Bye-bye.